Everyone, I wanted to bring attention to this document produced by the Forest Service in conjunction with universities, the University of Georgia and the University of Florida in this particular case. But the tax tips for forest landowners 2022 tax year. And I'm just going to highlight some of the information here and provide some basic information about forest land tax issues and timber tax issues. And in this video, I'm going to briefly describe the difference between a tax deduction, a tax amortization, and a tax credit in relation to income tax. And you may already have a basic idea about the difference between these three tax provisions. A deduction can be defined as a provision that reduces your taxable income, while an amortization is a provision that is essentially the same thing as a deduction, but it's spread out across several tax years. Thus, a deduction and an amortization reduce the amount of income that you owe tax on. And the impact of the deduction is related to your income tax bracket and the associated marginal tax rate. A credit, however, actually reduces the amount of tax that you owe. And so, in a way, it's kind of on the back end. So you determine the amount of income that you owe tax on. You then determine the amount of tax that you owe, and then you subtract the credit off of that amount of tax that you owe. So a tax credit is essentially a one-to-one dollar. It's an actual dollar reduction, where a deduction and amortization, their impact depends on your income tax bracket and the associated marginal tax rate. And as you can see, deductions, amortizations, and credits can be at the federal or state level. Next, we can look at the federal IRS Tax Form 1040. The U.S. individual income tax return. And you can see here is where you record all of your income and you get your adjusted gross income. And then here you can see you have your standard deduction or your itemized deductions. And of course you subtract these deductions from your adjusted gross income to get your taxable income. And then we turn to page 2, and you can see the tax and credits. And here you can see where you determine the amount of tax that you owe based on your taxable income and your income tax bracket and your associated marginal tax rate. And then you can see here's your credits. And thus you then subtract your credits from the amount of tax that you owe. And thus you can kind of see throughout this video how you've determined your amount of income, and then you've reduced that income through deductions and amortizations, adjustments, to determine your taxable income. You then determine the amount of tax that you owed, and then you subtracted from that your tax credits to determine the final amount of tax that you owe. And so this is what I meant when I said earlier, tax credits are on the back end. And therefore, hopefully you can see that a deduction is generally going to be preferred to an amortization because I'm receiving the benefit from that recovery from the deduction in the year in which the cost was incurred. It's generally preferred, right, because of the time value of money, and I can earn interest on that amount of recovery from the deduction. And inflation doesn't really reduce the buying power of the recovery from the deduction, such as with the recovery from the amortization. And that a credit is generally going to be preferred to a deduction and thus also preferred to an amortization. Thank you.